Good morning. It's Tuesday, the 5th of March, and this is Govindraj Ethiraj broadcasting from a distinctly cooler Mumbai, India's financial capital. I, of course, meant temperature. Our top stories and themes for the day. World markets hit highs again. India joins the party with smaller steps. Moody's catches up India's GDP projections. India ships crude from a big find in the Krishna Godavari basin. 26 years after launching its first car, Tata Motors to demerge passenger cars from parent commercial vehicles. And the Reserve Bank of India cracks down again, this time on IIFL's gold loans business.
This is a core report with Govindraj Ethiraj.
Global markets hit highs. Markets almost everywhere seem to be on a high once again. First at home, Indian shares moved up, albeit modestly, as was somewhat expected. But the small rises still took the indices to a third straight session of record highs. The blue chip NSE Nifty 50 hit a new record high of 22,440 before settling at 22,405. The BSE Sensex rose also to 73,872. Indian indices are still being powered by the surprise GDP numbers last Thursday evening, which showed that at 8.4%, the economy grew at its fastest pace in 6 quarters. And now world market highs were led by Japan's Nikkei 225, which closed above the 40,000 mark on Monday to set a record high. Earlier, the S&P 500 and the Nasdaq Composite hit fresh all-time highs on Friday. So the Nikkei's rise is historic, as we've pointed out earlier, having crossed its 1989 or 35-year high. Tech stocks are leading the way in Japan, somewhat similar to the United States, where artificial intelligence and companies like Nvidia are powering the rally at a scale never seen before. But overall, Japan's companies are reporting strong profits and now attracting more and more funds, also switching away from China. Even Warren Buffett has betted on Japan's trading houses. There are other interesting takeaways from Japan, also suggesting how companies there are responding to increased flows and interest. Bloomberg reports that companies are now being encouraged by the Tokyo Stock Exchange to publish reports on their plans to boost equity valuations. Some have announced share buybacks and dividend hikes. And management buyouts are on the rise, and activist investors are also stepping up their campaigns. Now, there are some small similarities with the Indian markets if you indeed choose to find them. Oil steadies and India starts shipping from new wells. Oil prices are now near their highest levels this year after the OPEC Plus extended production cuts to the end of next quarter. Brent crude was quoting just under $84 a barrel, even as the OPEC, which is the Organization of Petroleum Exporting Countries, and its allies extended a roughly 2 million barrel a day reduction through the end of June, with Russia saying that it was pledging added emphasis on cuts to production rather than exports, according to Bloomberg. Moody's raises India's growth forecast. With India now posting higher GDP and growth numbers, rating agencies have had little choice but to follow. Global rating agency Moody's on Monday raised India's growth forecast for the 2024 calendar year to 6.8% from 6.1% estimated earlier, on the back of what it calls stronger than expected economic data, which we all know, and more importantly, fading global economic headwinds. India's real GDP expanded 8.4% year-on-year in the fourth quarter of calendar year 2023, leading to a 7.7% growth for the full year 2023. Capital spending by the government and strong manufacturing activity have meaningfully contributed to the robust growth outcomes in 2023, Moody's said in a report quoted by Business Standard. Significantly, Moody said that global headwinds were fading, which should help the Indian economy comfortably register 6 to 7% real GDP growth, it added. The fact about global headwinds fading is, of course, new, at least as I can see, and something that should be watched out for perhaps more carefully. Moody's also said that India's economy has performed well, and stronger than expected data in 2023 has caused it to raise its 2024 growth estimate to 6.8%. And India is likely to remain the fastest growing amongst G20 economies in its forecast horizon. Looking ahead for 2025, GDP growth is estimated at 6.4%. Moody's also said that a robust goods and services tax collection, rising auto sales, consumer optimism, and double-digit credit growth suggests that urban consumption demand is strong and resilient. On the supply side, expanding manufacturing and services add to evidence of solid economic momentum. Moody's also said that it expects policy continuity after the general elections and a continued focus on infrastructure development. Finally, it said that while private industrial capital spending has been slow to pick up, it is expected to pick up with ongoing supply chain diversification benefits and investor response to the government's production-linked incentive scheme to boost key targeted manufacturing industries. India ships crude from the Krishna Godavari basin. Now, returning to oil, the Prime Minister Narendra Modi on Saturday flagged off the first tanker, Swarna Sindhu, carrying crude oil produced in ONGC's Krishna Godavari deepwater block off the eastern coast of India, details of which I'll come to in a moment. At its peak production, this project will apparently add 7% each to India's oil and gas production, according to ONGC. This project was developed with an investment of over 41,000 crore rupees and is called the KG-DWN98-2 Deepwater Oil Field M in the Krishna Godavari Basin and is considered to be one of the most technologically complex projects in India's oil and gas industry to date, reported Reuters. ONGC says the project is a key step in cutting India's dependency on crude and liquefied natural gas imports. India imports about 85% of its crude currently. The drilling is located offshore the Godavari River Delta in the Bay of Bengal, about 22 kilometers off the coast of Andhra Pradesh, in a water depth of over 430 meters, and it achieved first oil on January 7th. 26 years on, Tata Motors splits businesses. Tata Motors on Monday has said it will demerge its business operations into two different entities, its larger commercial vehicle business from its smaller passenger vehicle business. The move clearly represents some rapid value unlocking and reorganization for this roughly $42 billion automotive giant, particularly if you put the pieces together, or rather, move them apart. Before I go further, Jaguar Land Rover is a 100% subsidiary of Tata Motors but is actually much larger than both the Indian commercial vehicle and passenger vehicle business combined. And I'll come to that in a moment. A small walk down history lane. Tata Motors was set up in 1945 as Telco to make locomotives and engineering goods. The locomotive part obviously went away even as the government moved in. You may of course remember that we spoke about Grasim and Asian Paints in somewhat different contexts, actually paints, though both were born in the vicinity of 1947 as Tata Motors was. The interesting thing is that Tata Motors has been a commercial vehicle maker for almost 45 years of its life, since 1954 when it started making them, although in various forms or different forms of trucks, light and heavy. The first car actually only arrived in 1998 in the form of Indica and Indigo in 2002. The Sumo, the ubiquitous SUV brand, for a long time came in 1994. The transition to a car was a tough one for Tata Motors, as you can imagine, since it was making trucks for most of its life. And the move was, of course, driven as much by willpower as much as engineering capabilities, and is, of course, another long story. The Tatas acquired Jaguar Land Rover, Britain's largest automotive company, in 2008, and that became the luxury vehicle business of the Tatas. So, the commercial vehicle business is worth around 71,000 crore rupees and represents a roughly 41% share of the market. The domestic passenger vehicle market is about 48,000 crore rupees but represents only about 13.5% of the market, which in itself is reasonably large given the way the automotive market is stacked up, with Maruti leading there. Obviously, competition is much stiffer here, and herein lies something interesting. The commercial vehicle business is larger, like we said, but growing more slowly, while the passenger car market has far more potential for growth, including via electric, and that could have obviously caused or accelerated the split, so investors get a chance to bet on growth separately without being weighed down by commercial vehicles. Now, Jaguar Land Rover, by the way, is worth over, when I say worth, I mean sales of 222,000 crore rupees, while the total revenue for the whole company is about 351,000 crore rupees, or back to $43 billion. Tata's electric vehicles business was launched 5 years ago in 2019, which of course became another subsidiary 2 years later in December 2021, and will, if reports are to be believed, go for an IPO as well in a year or so. Remember, subsidiary and engineering and design company Tata Technologies went public with a blowout IPO or initial public offer in November last year. Now, back to the scheme of the demerger. As we know, the company says all shareholders of Tata Motors will continue to hold the same identical shareholding in both the listed entities. Tata Motors said in a stock exchange intimation that the demerger is a logical progression of the subsidiarization of passenger vehicles and electric vehicles businesses done earlier in 2022, and shall further empower the respective businesses to pursue their respective strategies to deliver higher growth with greater agility, even while reinforcing accountability. Post demerger, one entity would house the commercial vehicles business and its related investments, while the other would house the passenger vehicles business, including passenger vehicles, electric vehicles, Jaguar and Land Rover, and related investments. The whole process could take a little over a year, though all these companies have, as the company says, been operating under independent CEOs since 2021. The Tata Motors chairman N. Chandrasekaran said the three automotive companies were now operating independently and delivering consistent performance and could now better capitalize on the opportunities provided by the market, which goes back to all of which we've been saying so far. Incidentally, Tata Motors has about 90 consolidated subsidiaries, 2 joint operations, 4 joint ventures, and 11 equity associations or companies in which I would believe it holds strategic equity. So that's a lot of ventures under roof, but it's a long time too, and a long journey, and a long way, of course, from locomotives. The Reserve Bank of India cracks the whip again, this time on IIFL Finance. The Reserve Bank of India on Monday barred IIFL Finance with immediate effect from sanctioning or dispersing gold loans after apparently certain material supervisory concerns were observed in its gold loan portfolio, reported the Business Standard. From what it sounds, it does appear that the company seemed to be giving away some loans without checking fully the purity of the gold that was being offered as collateral, which in turn came to light at the time of auction when those borrowers defaulted. The Reserve Bank of India has been, of course, cracking down across asset classes, including fintech companies, and we'll come to that in a bit. The Reserve Bank of India said IIFL Finance can, however, continue to service its existing gold loan portfolio through the usual collection and recovery process. The Reserve Bank also said it has specifically directed IIFL Finance to cease and desist with immediate effect from sanctioning or dispersing gold loans or assigning, securitizing, or selling any of its gold loans. An inspection of the company was apparently carried out with reference to its position or its financial position as of March 31st, 2023. The Reserve Bank said that material supervisory concerns were observed in the gold loan portfolio of the company, including serious deviations in assaying and certifying purity and net weight of the gold at the time of sanction of loans and at the time of auction upon default. These practices, apart from being regulatory violations, also significantly and adversely impact the interest of the consumers, the central bank said. The Reserve Bank also said that supervisory restrictions will be reviewed upon completion of a special audit to be instituted and after rectification by the company of those audit findings. Now, there is a larger question about the Reserve Bank of India's actions and the increasing number of them, including in the case of fintech companies like Paytm Payments Bank, which in turn quite predictably triggered howls of protest from the fintech community. So I reached out to Tamal Bandyopadhyay, veteran commentator of banking issues and columnist with Business Standard, and I began by asking him if the Reserve Bank of India's actions reflected a larger systemic problem arising out of perhaps the retail excesses of the last few years.
I think the way you look at it, is there something wrong with the Indian financial system? I would not say this. I would say the common thread is there's a new Reserve Bank. What I meant is the way RBI supervises the regulated entities. It's changed. Now, about a decade back, I'm just saying, even the post-Lehman 2009-10, what was the thing? RBI was toying between upside and on-site supervision. It's like it will be transaction-based, then it will be also data collection. And then what was there that they created a new supervisory framework sometime, again, I said more than a decade back, which is called SPARC, SPARC. SPARC means Supervisory Program for Assessment of Risk and Capital. And that was based on the report of the committee. This SPARC, what happened is this, they replace something called risk-based supervision, which is called RBS. which was a very, very complex model. I'm not getting into all the technicalities and all. But RBS was very complex. In the first phase, when it rolled out, I think, if I'm not mistaken, exactly a decade back, there was a very comprehensive evaluation, both present and future risk and incipient issues, etc., etc. So that would help Reserve Bank of India to what kind of supervisory stance it will take. And the main thing is, instead of corrective action, it will be rather intervention, meaning you won't wait for things to happen. You actually attack. I know the so-called nip in the bud. That's the kind of situation. Every banker and those who are familiar with the banking financial system, they would know the same thing called camel region, or camels in India, they call it camels. That has been the globally Basel accepted thing. What do camels stand for? C for capital adequacy, A for asset quality, M for management, E for earnings, L for liquidity. And in Indian context, we added S, system and control, etc. So camels was going on. And if you remember, we had early this century, one of the new private banks was taken over by Oriental Bank of Commerce. It had fallen, some problem was there. Then you had all the issues of, multiple other issues and all. And as good as, that the PNB, massive, biggest scam, Punjab National Bank, that got hit by that. I'm leaving aside Yes Bank and others, etc. That's an individual driven. That is not a systemic thing. So now this camels was thing, but the camels, and through this spark, now RBI has on this, the RBS. RBS is the risk-based supervision. And this risk-based supervision, again, if I'm not mistaken, I think 2017 sometime it came, and it is now completely over every bank is covered by that and all. So it's not a kind of on-site or light touch or supervision, nothing. It has been completely reversed. It's been completely reversed. It is very lot of dependence on transactions testing and very thematic based on samples. And it's continuously runs through the year. Typically the bank's inspectors will not only focus on the headquarters, now they will focus on the branches, normal branches, specialized branches, controlling offices, etc., etc. And, they are also earlier used to think that they just paper clippings will help. Now they keep a very close tab. RBI supervision is also what the local radio is saying, what the social media is talking about, what is there on Facebook, what is there on Twitter, what was there, all kind of things and all. If some customer are angry and this on the social media, they also tap that. It's a very, very, very new Reserve Bank of India. And the bedrock of this model, if you ask me, it's called the Central Depository of Information on Large Credits, that CRILC, or CRILC. It's about a decade back, it was opened. It means that every bank has to keep the Reserve Bank of India posted on their bad loans on a real-time basis kind of thing. And this is not available to you and me. This is not available to other regulators. This is not available to rating agencies. So that's the one part of it. That's check the health of banks. But the other part of this, what you are asking is the common thread is this. This Reserve Bank of India is very aggressive. It's a sort of paranoia, positive paranoia. Positive paranoia said that it would not allow anything to wrong. And like earlier, if an inspector tells his proximate boss, every bank, depending on the profile of the bank, or NBFCs do not have this, the banks have that one inspector, depending on the profile of the Reserve Bank of India. But State Bank of India will have more than one inspector from Reserve Bank of India at very high level. A smaller bank will have one inspector, probably medium level. Now, earlier, 5 years back, inspector tells his proximate boss, "Yes, sir, I have got this, found this, etc., etc., etc." Some hera-fairy, some evergreening, something wrong. And this fellow will be garlanded. What a great job you have done. But this time, if the inspector says like that, his boss will just scold him. "What the hell you are doing? Were you sleeping? Why did you catch it early? Why are you telling me now?" So this is the new Reserve Bank of India under DAS. It wants to, as I said again, nip in the bud. It will not. So be it banks, be it non-banks, be it small finance bank, be it NBFCs, or you are talking about that gold loan of IIFL, you are talking about that, or Bajaj Finance, certain issues, or payment banks, etc., etc. Because this is a systemic issue. One bank or one NBFC can affect others. So If you see in the past, Reserve Bank of India has already, sometimes do people say that our central bank is pretty slow in its approach, it gives a long rope, etc. Even as we speak, sometimes it does give a long rope, keeping in mind how important is this systematically, this particular thing. You and me do not know. Tomorrow you will find probably yet another entity. I'm just hypothetically saying that on the RBI radar, and very stern action is taken against the entity. Now you will say, what the hell was doing? Why did RBI take so long if it knew? But we don't know. Probably Reserve Bank of India is in continuous touch with that entity and trying. Only when the patience runs out, then it comes. Now, do you know this Reserve Bank of India started this? Certainly, you will find that RBI senior executive inviting himself or herself to a bank's board and explaining things, what is not going right with that particular bank or payments bank or universal bank or small finance bank. I'm not getting into the names or anything like that, but I'm just trying to give you the what is new and what is the common thread. This Reserve Bank of India's patience for entities which would like to sort of creatively interpret regulations and do things in a different way. I think this will not be allowed at any cost. That's very fast. And this RBI is very fast in a relative term in catching and raising the white flag. It's almost on a real-time basis in certain cases. It wants to tell them, and then they keep on reminding them. And when the patience is lost, it comes to the public domain. And again, depending on the size of the entity and its importance in the financial system for the financial stability point of view, that kind of time it will be taken. But otherwise, the common thread is here is an RBI which does not encourage, I would say, kind of, it's not a question of inefficiency or a thing, but the misgovernance and taking the system for a ride. Entities will not be able to do this for long. RBI is pretty alert. I must give the devil to its due.
Could one say that the action on the fintech companies is really an extension of this rather than more a focus on the tech and so on?
Absolutely a part of it, not extension, a part of it. And again, Govind, you are also making the mistake. What is there against a fintech? Where does fintech come in? It's against a payment bank. Then the question is, if it takes on one of the smart public private bank or even State Bank of India, then also it's against a fintech. I mean, where does the fintech come in? It's about a payments bank. Fintech has nothing to do with this, right? Now, so fintech is two different things. One is part fin and one is tech. As far as fin is concerned, it's all about managing risk. It's all about trust. Now, tech does not care about that much. So when you mix this and make it a fintech, then you run the risk that tech side takes over the fin side, and which is very different from the tech. That the banking laws and regulations, basically it's a question of trust because banks deal with your money and my money. Techs don't do. So when the techies are doing banking, if the techies do, like I have multiple organizations within my fold, and some guys will do tech and some guys will do fin, etc., etc. And then the data, because my fin guys are having all the access to data, the data will be passed on to my tech guys, and I'll make a khichdi out of this. That's not following the regulation. So I am challenging the very notion that what you are talking about, Reserve Bank of India's action against a particular payments bank is RBI's impatience or RBI's, coming down heavily on a fintech. It's a payment bank. It's not a fintech. Come on. There are many other payment banks. And if you call it an attack on a fintech, then anything happens to ICICI, HDFC, Axis Bank, or even State Bank of India, you'll call it's an attack on fintech. Because they are all run and they're all heavily, they're all in some sense, they're all run. They themselves don't call them neo-bank, but there's a digital bank within every bank. So I think it's a misinterpretation and we are also party to it. I think we don't come forward to dispel the myth. There's nothing to do with fintech. There's nothing to do with fintech.
Right. Tamal, this is a very, very important and useful insight. Thank you very much for this.
Thank you, sir. Thank you.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.